It's now become impossible for fund managers to ignore gold, gold has outperformed every single other asset class. And this huge untapped source of investment have yet to come into gold. And they're only just waking up to it. And I think Peter Grandage said the average fund manager has maybe 0.5% exposure. That's interesting. So this fresh incoming investment demand into already tight supply indicates 3,000 gold is massively underpriced.
For decades, gold has been dismissed as a relic of the past, a defensive asset used by central banks and cautious investors to hedge against inflation. Meanwhile, the financial world has been dominated by stocks, bonds, and digital assets, with gold playing a secondary role. But now, something is changing. A historic shift is underway, one that is forcing even the most reluctant fund managers to reconsider their stance on gold. The numbers don't lie. In recent years, gold has outperformed nearly every other asset class, delivering steady gains even as global markets struggle with uncertainty. This shift isn't just about speculation, it's about necessity. With the implementation of Basel III banking regulations, the very structure of the gold market is being rewritten. For decades, large financial institutions have relied on paper gold, futures contracts and derivatives representing claims to gold, but are rarely settled in physical bullion. This system has allowed for massive price manipulation, suppressing gold's true value. However, under Basel III, these unbacked contracts are becoming increasingly unsustainable. Physical gold is reclaiming its role as the ultimate form of financial security, and central banks around the world are racing to secure their reserves before it's too late. At the heart of this transformation lies an even greater challenge: the Federal Reserve's gold repatriation problem. The U.S. has long been a dominant player in the gold market, but years of leasing and rehypothecation, where the same gold is promised to multiple parties, have left the Fed with a serious dilemma. With Basel III compliance approaching, the Fed now faces an urgent need to repatriate physical gold to cover decades of questionable financial practices. The stakes couldn't be higher. If they fail, the dollar's credibility could be severely undermined, and gold prices could surge beyond all expectations. In a recent video, renowned precious metals analyst and whistleblower Andrew Maguire breaks down the situation, suggesting that gold prices are about to get much higher in 2025. As we present clips from the video, please share and like this video, subscribe to the channel, and turn on the notifications bell for instant alerts. We appreciate the support and hope you enjoy the video.
What we'll do is we will actually look at these upcoming stair steps into the next 3 quarters, because that's our job now, is to really use everything that take all the pieces that we can see from the wholesale market especially, and kind of give us a good sense of where we actually should be. And because really what we're seeing is a drain of paper market price setting liquidity, and it is flowing out into the physically settled exchanges. So I'm happy to go out on a limb with price discovery migrating out of this legacy car sales sphere influence. It's getting a lot easier, and that's why 3,000 wasn't hard to figure out. So what I'm saying is this, because of this drain of paper market liquidity into the physical markets, the lines have crossed irreversibly, and we are evidencing a real physical gold price emerging. And as we will see, it's got a long way to go yet. And as we drew attention to in our last episode, which was 2 weeks ago, the gold market bear squeeze is actually gaining momentum. And a look at this last 2 weeks action really does provide us more evidence of the race to short cover ahead of the 1st of July, Basel III compliance, which is a big deal. Let's start by looking at the larger picture then. Then we'll look at the end of the quarter footprints. And based on what we are once again seeing in the tight for supply physical markets, then we'll have some projections for the end of the next 3 quarters into 2026. It's not about the Fed or tariffs. We're privileged to be witnessing the early stages of a gold price revaluation, which is an ongoing process, not a single event. We're witnessing it. We're privileged to see this historic thing unfold. However, there will be some inflection points, which we will, as we witnessed a bullish one, as we witnessed when the Shanghai Futures Exchange launched at $2,000 back in March last year. And now a similar bullish driver is the run up to the 1st of July. And we'll look at that a bit closer in a little while. But all our projections have relied upon where central bank sovereign buy interest is, and it's been steadily stair-stepping higher. It's now become impossible for fund managers to ignore gold, gold has outperformed every single other asset class. And this huge untapped source of investment have yet to come into gold. And they're only just waking up to it. And I think Peter Grandage said the average fund manager has maybe 0.5% exposure. That's interesting. So this fresh incoming investment demand into already tight supply indicates 3,000 gold is massively underpriced. So let's take a look at the footprints and where they're ultimately headed and why. And as we summed up in our last episode, into stretched out physical gold delivery timelines, which are delivery defaults by no other name, an increasing percentage of leveraged COMEX paper market gold longs, they're fully paying up their COMEX positions to force physical delivery. Now, we call this the sticky open interest, which is the fund managers who are buying it for a reason, for the right reasons. But it's also forcing large COMEX outflow into the exchange traded funds, compounded by physical buyers targeting the COMEX backdoor EFP mechanism, the backdoor EFP mechanism, which is the Achilles heel. That then forces a non-Basel III compliant paper price, lands in London on a T+1 delivery basis in a compliant market, and what was previously cash settled comes into full physical settlement into this Basel III compliant local London market. Now, look, it's easier to illustrate when we pop in to look at the charts.
As you've just heard from Andrew Maguire, the gold market is undergoing a fundamental transformation, one that has been years in the making. The key driver behind this shift is Basel III compliance, a set of banking regulations introduced by the Basel Committee on Banking Supervision, BCBS, in response to the 2008 financial crisis. Under Basel III, gold is no longer treated as a Tier 3 asset, which was previously subject to heavy capital penalties when held by banks. Instead, it has been reclassified as a Tier 1 asset, meaning that physical gold holdings are now considered a high-quality, liquid asset, on par with cash and government bonds. However, the catch is that only fully allocated, unencumbered physical gold qualifies under these new rules. Paper gold, such as futures contracts, unallocated gold accounts, and derivatives, does not. This distinction is critical because, for decades, large financial institutions have relied on leveraged paper gold markets to suppress prices and maintain control over price discovery. But with Basel III forcing banks to back their positions with actual bullion, this system is breaking down. The implications of this shift are enormous. Central banks, sovereign funds, and institutional investors who previously treated gold as an afterthought are now realizing that the market dynamics have fundamentally changed. The artificial price suppression that once dictated gold's value is unraveling, and as Maguire pointed out, the migration from paper to physical gold has already reached an irreversible point. This is why gold's price trajectory is no longer following the same patterns we've seen in previous years. We are entering a new era of gold valuation, one where physical supply and demand are taking precedence over speculative manipulation. At the same time, this regulatory shift has placed the Federal Reserve in a precarious position. For years, the Fed, alongside major bullion banks, has engaged in rehypothecation, meaning that the same physical gold reserves have been pledged multiple times through swaps, leases, and derivative contracts. Now, with Basel III's enforcement, the Fed is facing a gold repatriation crisis, a desperate scramble to secure enough physical gold to meet its obligations before the July 1, 2025 compliance deadline. If they fail to do so, confidence in the dollar and the U.S. financial system could face serious consequences. Let's get back to Andrew Maguire's video.
And what we're really trying to illustrate here is the structural bullish change in behavior, which is the paper to physical market behavior, that is becoming increasingly difficult for officials to hide. Now, there's insufficient non-sticky open interest. We've talked about that multiple times, which is really, we're just talking about the cash settled speculator held bets, which are dwindling. So there's insufficient of this open interest to target to generate historical sell ignition waterfalls, which we've experienced over multiple years. In fact, these large COMEX short covering footprints into higher prices and declining open interest closely mirror the period the BIS, that was the Bank of International Settlements, moved to square all their remaining asymmetrically imbalanced gold derivative bets ahead of the upcoming Basel III spot FX market compliance on the 1st of January. So they front ran that. Now, much as we see the Fed really doing the same thing, really attempting to step up gold repatriation, really to front run, similar to what the BIS front ran on the 1st of January, obviously. And that culminated in really that a notable capitulative short covering event on the 30th of November at spot $1,616, where they zeroed the last the remaining 500 tons of asymmetrically imbalanced derivative bets, which they'd been holding on to for some 50 years. Now, 2 years on, into the end of the first quarter, and we're just approaching that next week. So it now costs over $1,400 more depreciating dollars to buy the same ounce, kilo, and ton of gold. Now, Basel III compliance marked the exact inflection point where the European and the global south-facing Bank of International Settlements diverged from the wrong-footed Fed, requiring they needed an additional 2.5 years on the 1st of July 2025 to be able to extricate themselves from their share of really over 50 years of historically accrued, rehypothecated gold leases and swaps.
So in summary, the moment freshly revalued global facing first tier non-stable, NSFR compliant, a net stable funding ratio compliant foreign exchange gold, i.e. real gold, the moment it was crossed against the dollar and became T+1 deliverable, 1 day deliverable, it also placed the non-compliant paperback COMEX futures dilutive prices into the crosshairs to be targeted by central bank sovereigns and institutionals. However, the inward-facing siloed paper market was actually granted, and this is where it gets interesting, they granted the Fed an additional 2 years extra time to repatriate sufficient physical bullion to repay billions of mismanaged, rehypothecated treasury gold IOUs.
Now, while repatriating bullion has been a slow process, under the bid-pull volatility, and we note there's no fresh shorts in excess of what can be offset directly by rinsing naked long speculators, so they do not dare to add any shorts beyond that because they're trying to repatriate. So really, with shrinking open interest, that's becoming more and more difficult. So what we're saying is the paper to physical exchange for physical gap has steadily been closing, picking up significantly.
The Federal Reserve now finds itself caught in a race against time. With Basel III regulations forcing a shift toward physical gold-backed markets, the Fed, like many Western central banks, must secure enough bullion to cover decades of leveraged, rehypothecated gold leases and swaps. The problem? There simply isn't enough readily available gold to meet the demand. Years of paper gold manipulation have left Western reserves dangerously thin, while countries like China, Russia, and much of the global South have been quietly amassing physical gold in preparation for a post-dollar monetary landscape. As Maguire noted, the gap between paper gold and physical gold pricing is closing fast. This means that institutions previously comfortable with paper gold exposure are now being forced to shift to actual physical settlement. Every ounce of repatriated gold further tightens supply, driving prices higher and pushing central banks, sovereign funds, and institutional investors into a scramble to secure whatever gold they can before it's too late. This is why Maguire confidently projects gold reaching $3,500 and beyond, not as speculation, but as an inevitable consequence of a structurally changing market. The real question now is, can the Fed complete its repatriation in time? If not, we could see a financial shockwave unlike anything in modern history, one that forces a complete revaluation of gold's role in global finance. The dollar's supremacy, long underpinned by the perception of stability and control over gold pricing, may soon be challenged in ways most investors never expected. This is not just another bull cycle for gold, it is a reawakening. The question isn't whether gold will continue to break new records, it's how fast it will. The gold market is changing, permanently. We've just explored how Basel III is reshaping the financial landscape and why the Fed is in a desperate race to secure physical gold. But this is just the beginning. Are you prepared for what's coming? If you found this analysis valuable, make sure to like this video, subscribe, and hit the notification bell so you don't miss the next deep dive. Drop a comment below. Do you think the Fed can complete its gold repatriation in time, or are we heading for a financial shockwave? Let's get the conversation started. And if you're serious about staying ahead in this gold revaluation era, share this video with others who need to know the truth about what's happening behind the scenes. Thanks for watching, and see you in the next one.